On the morning of October 24th, 1929, a man named Charles Mitchell walked into his office at the National City Bank in New York City and prepared for what he expected to be a normal Thursday. By the time that day ended, Americans had lost $14 billion, more than the entire United States had spent fighting the First World War. 13 million shares changed hands in a single session of blind panic. The telephone lines connecting brokers to the stock exchange collapsed under the weight of desperate calls. Fortunes that had taken lifetimes to build vanished in hours, and almost nobody knew, then or for decades afterward, that this catastrophe had a single architect, a man the newspapers had called Sunshine Charlie, a man who had, 7 months earlier, made one decision that set the entire mechanism in motion. A man who, when Congress called him to account 4 years later, looked at the senators across the table and said, without apparent irony, that he had wanted to give ordinary Americans a chance to get rich. This is the story of Charles Mitchell, the Great Depression, and what it teaches us about every financial crisis that has happened since. To understand what Mitchell did, you have to understand the America he did it in. The 1920s were unlike anything the country had ever experienced. The automobile was becoming a mass-market product. Radio was reaching into homes across the country. Jazz was filling clubs from Harlem to Chicago. Skyscrapers were rising in every major city. The gross domestic product was growing at a rate that seemed, to the people living through it, like a permanent new condition of American life. Between 1922 and 1929, the economy expanded by nearly 40%. Corporate profits doubled. The stock market tripled. It felt genuinely like prosperity had become the permanent state of the American nation, but it was the prosperity of a specific class of people. In 1918, when Charles Mitchell took over the National City Bank, which was then the largest bank in the United States, with assets of $2.7 billion, only about 500,000 Americans owned stock, less than 1% of the population. The stock market was a private club for the rich. Ordinary people, the factory workers and farmers and teachers and shopkeepers who made up the overwhelming majority of the country, kept their savings in banks or bought government bonds. Wall Street was not their world. It was a sealed-off system for people who already had more money than they needed. Mitchell looked at those 500,000 investors and saw not a comfortable market, but an inexcusable waste of potential. His idea was startling in its simplicity, and its ambition? He wanted to democratize Wall Street. He believed that every American deserved access to the wealth-building power of the stock market, not just the already wealthy. He was going to bring investing to the masses. He was also going to make himself extraordinarily rich in the process. But that part was less prominently advertised. Charles Edwin Mitchell was born in 1877 into a farming family in Massachusetts. Nothing in his background suggested that this farmer's son would one day become the most influential banker in the country and change the destiny of a nation. He was not from an elite family. He had no powerful connections inherited at birth. What he had was a gift for salesmanship and a genuine, possibly sincere belief that the financial system as it existed was unnecessarily closed to the average American. Whether that belief was the cause of what he built or merely its cover story, history has never fully resolved. What is certain is that he acted on it, and that the consequences of his actions reverberate to this day. In 1920, Mitchell created a subsidiary of National City Bank called the National City Company. Its mission was straightforward: sell stocks and bonds directly to ordinary Americans through bank branch offices. When a customer came in to open a savings account, they would be offered the opportunity to invest in American corporations. Mitchell transformed the sale of securities into an art form. He studied psychology, the mechanics of desire, the architecture of human hope and fear. He hired and trained an army of salespeople and deployed them across 69 bank branches nationwide. These were not stodgy bankers in three-piece suits delivering cautious advice. They were professionals trained in persuasion, in the science of closing a sale, in the subtle art of making a risky financial product feel like a safe and patriotic act. The advertising was revolutionary for its time. Newspaper ads ran in cities across the country with slogans that spoke directly to the anxieties and dreams of working Americans. Become a partner in American Telephone and Telegraph. Get rich by investing just $15 a month. Your children will be proud of you. Magazines published success stories that had been carefully curated for maximum inspirational effect. The secretary from Ohio, who doubled her savings in 2 years by buying utility stocks. The streetcar driver from Cleveland, who purchased his own home using stock dividends. The factory worker in Pittsburgh, who retired at 50 because he had trusted the market. The efficiency of Mitchell's sales operation was remarkable for its time and would be recognized immediately by anyone familiar with modern financial marketing. The bank identified which neighborhoods had the highest concentration of households with small savings, specifically the skilled working class that had enough income to set something aside, but not enough wealth to have existing financial advisors. They hired salespeople who looked and spoke like the people they were selling to, not the patrician bankers who had previously represented Wall Street, but friendly, accessible men who understood the anxiety of living month to month and could speak credibly about the possibility of something better. The branch offices were positioned near where working people already went, near factory gates, near union halls, near the savings and loan associations that had previously captured this market. Sales agents were trained to use scripts refined through months of trial and error. If a customer hesitated, the agent would say, "Mr. Johnson, don't you want to stop working for someone else your whole life? These General Electric shares are your chance to become the master of your own financial destiny." If a customer seemed unmoved by the promise of wealth, the agent would try a different angle. "Mrs. Smith, your husband works at Ford. Doesn't it seem right that you should also own a piece of the company he helps make successful?" National City branch offices were decorated with large photographs of happy families standing in front of substantial houses. "Thanks to our shares, we bought the home of our dreams." Everything in the environment was designed to associate stock ownership with security, prosperity, and the fulfilled American life. What these salespeople were actually selling, in many cases, was not as safe as it appeared. The stocks National City Company was pushing most aggressively were often the stocks that National City Bank was being paid to underwrite, meaning the bank had a financial incentive to move them at high prices, and the salespeople had a commission incentive to move them in large quantities. The research that would have allowed a customer to evaluate what they were buying was not provided. The conflicts of interest were not disclosed. A customer sitting across a desk from a friendly, professional National City salesperson in 1927 had no idea that the salesperson's branch manager had received a memo that morning listing the specific securities the branch needed to move that week, or that those securities had been selected not because they were the best investments available for that customer, but because the bank had warehoused too many of them and needed to reduce its own exposure. The most ingenious and ultimately most destructive part of the system was margin lending. Stocks could be purchased on credit, with an investor putting up as little as 10% of the purchase price and borrowing the rest from the bank. The sales pitch made this seem like pure upside. You have $100. You use it as a down payment to buy $1,000 worth of stock. The stock rises 20%. You sell it for $1,200. You pay back the $900 loan and pocket $300 profit. You just tripled your original $100. Spectacular, rational, irresistible. What the pitch omitted, and what the fine print buried in language that most investors did not read or did not understand, was the downside scenario. If the stock falls 10%, the bank issues a margin call, produce more cash immediately to cover the loss, or we will sell your shares at the current low price. If you cannot produce the cash, which most people could not because they had borrowed to buy in the first place, you lose everything and still owe the money you borrowed. The system was a ratchet that turned in only one direction when the market was rising. When it reversed, the ratchet turned back with equal and opposite force. But the force was not distributed equally. The bank got its money back first, and the investor absorbed the remainder. The results exceeded every ambition Mitchell had articulated. Between 1925 and 1929, the volume of margin lending for stock purchases grew from $2 billion to $8.5 billion, an increase of more than 400% in 4 years. The number of Americans who owned stocks grew from 500,000 to 10 million people. A professor in Ohio mortgaged his house to buy shares in Radio Corporation of America. A farmer in Kansas sold his cattle to buy General Motors. A mechanic in Detroit invested 6 months of wages in Ford Motor Company stock. Housewives managed investment portfolios at kitchen tables. The stock market ceased to be a closed club and became a national obsession, discussed in barber shops and church basements and factory cafeterias. Charles Mitchell was celebrated as a visionary. The press called him a genius, a financial democratizer, the man who had opened the temple of wealth to the American masses. He was photographed with presidents and senators. He gave speeches to packed auditoriums about the permanent prosperity that American capitalism had achieved. In 1928, he earned $1.2 million from his work at National City Bank. In today's money, that is roughly $20 million. He was, by any measure, living proof of his own thesis. The American financial system, properly accessed, could make any smart and ambitious man extraordinarily rich. But Mitchell went further than simply selling stocks to customers. He created a more elaborate structure, one that amplified the risks far beyond what any individual investor could see. He established investment trusts, pooled funds that used borrowed money to buy stocks. Those trusts themselves became corporations with publicly traded shares. Shares in the trusts were then purchased by investors on credit. The result was a pyramid of debt stacked 3 and 4 layers deep, each layer leveraged against the one below it, the entire structure resting on the bedrock assumption that stock prices would keep rising indefinitely. As long as the market went up, every layer of the pyramid generated returns that seemed to justify every layer of the debt. If the market stopped going up, even briefly and slightly, the pyramid would not just shrink, it would collapse inward on itself, each falling layer triggering the next. By the spring of 1929, even the most optimistic observers were beginning to feel something they could not quite name. Stock prices had risen far faster than the earnings of the underlying companies could support. The most popular stocks in the country were trading at 15 times their annual earnings, a ratio that, by historical standards, indicated not a healthy market, but a speculative mania. The Federal Reserve, watching the numbers pile up, issued warnings to member banks: stop lending for stock market speculation. The central bank wanted margin requirements tightened. It wanted the bubble deflated slowly, while there was still time to do it without catastrophe. The market responded to the Federal Reserve's warning with a sharp decline in March of 1929. In the space of a few days, billions of dollars of paper wealth evaporated. Panic was spreading through brokerage offices. It was beginning to look like the correction the Federal Reserve had hoped to engineer was actually happening. And then, on March 26, 1929, Charles Mitchell stood before the assembled press of New York City and said the words that sealed the fate of 10 million American investors. He announced that the National City Bank would provide the market with whatever liquidity it needed. He would not allow an unnecessary crisis to occur. He was, in effect, publicly overriding the Federal Reserve's warning with the personal guarantee of the most prominent banker in the country. The press coverage was rapturous. Front pages across the country declared that Sunshine Charlie had saved the market. Stocks recovered not just their losses, but pushed to new highs. The mild deflation the Federal Reserve had hoped to engineer was reversed. The bubble, instead of deflating slowly, inflated further. What followed was the final and most frenzied phase of the madness. Through the summer of 1929, stock prices climbed to altitudes that were entirely disconnected from the earnings and prospects of the companies they represented. The Dow Jones Industrial Average reached 381 points in September of 1929, a record that would not be surpassed for the next 25 years. 3 million new Americans entered the market in the last few months before the crash. The country was, collectively, drunk on the illusion of infinite wealth. When the shoeshine boy who polished your shoes started giving you stock tips about which companies to buy, that was not a sign that investment wisdom had been democratized. It was a sign that everyone who understood the exit had already used it. Behind the visible frenzy, a quieter and more calculated process was underway. The people who actually understood how the system worked were getting out. Large institutional investors, pension funds, insurance companies, and the banks themselves were quietly liquidating their positions throughout the summer of 1929. They sold in small blocks, carefully enough not to trigger the collapse before they had finished exiting. Joseph Kennedy, father of the future president, later described his own moment of realization. When his shoeshine boy started giving him stock tips, Kennedy sold everything. The logic was not that shoeshine boys are stupid. The logic was that if everyone, including people with no access to sophisticated financial analysis, was convinced the market could only go up, then there were no buyers left. And a market with no new buyers has only one direction left to go. The patience ran out in October. On the morning of October 24, 1929, the large New York investment funds made a coordinated decision. It was time to exit. They began selling in massive blocks simultaneously. Hundreds of thousands of shares hit the market at once. Prices fell, slowly at first, then in an avalanche. By midday, panic was spreading across the exchange floor. The telephone system collapsed under the weight of calls that could not be answered fast enough. Ticker tape ran hours behind the actual trading, meaning investors watching it did not know whether the prices they were seeing reflected reality. Men who had been millionaires on paper at 9 in the morning did not know whether they were still millionaires or paupers by noon. The domino sequence that Mitchell had constructed over 9 years now ran in reverse at terrifying speed. The first domino, falling stock prices, triggered margin calls from banks, demanding additional cash from investors who had borrowed to buy. The second domino, investors had no cash available. They had put everything into the market. They were forced to sell stocks to meet the margin calls, which pushed prices lower still, which triggered more margin calls, which forced more selling. The third domino, falling stock prices were no longer worth enough to serve as collateral for new loans. Banks stopped lending entirely, which drained the market of the liquidity it needed to function. The fourth domino, banks that had made too many margin loans began to fail because the collateral backing those loans was now worth less than the loans themselves. 13 million shares traded on that single Thursday, 5 times the normal volume. The exchange struggled to process the orders. In the days that followed, the market partially recovered, then collapsed again. October 29, 1929, Black Tuesday, was the worst single day in the history of American finance. $14 billion of value disappeared between the opening bell and the closing bell. Not lost, not redistributed, destroyed. Numbers on ledgers that had represented real wealth, real savings, real futures, reduced to zero. The human consequences reached into every corner of American life. Edward Hopkins, a mechanic in Detroit, had invested $5,000 in Ford Motor Company stock over several years. This was the savings of a working lifetime. By November of 1929, those shares were worth $200, and the bank was demanding $3,000 in additional margin payments. Unable to produce the money and unable to look at what he had done to his family's future, he hanged himself in his garage. Mary Canfield, a school teacher in Ohio, had mortgaged her parents' family home to buy shares in Radio Corporation of America, which had seemed in 1928 like the most obviously correct investment decision in history. After the crash, the bank foreclosed. 3 generations of her family, the parents who had worked their whole lives to own that house, her own children, were turned out into the street. In New York, men who had dressed in fine suits and taken taxis and talked about their portfolios at lunch stood in bread lines wrapped around city blocks. The Brooklyn Bridge acquired a grim reputation as a destination for men who had considered themselves wealthy one week and ruined the next. Suicides reached record levels across the country. The sense of personal shame that many people felt was itself a product of the system Mitchell had built. He had sold the market as a meritocracy, as a place where smart, hard-working people would be rewarded. The people who lost everything believed in many cases that they had failed individually rather than been failed systemically. The Great Depression that followed lasted 10 years. 25 million Americans, 1 in 4 working people, lost their jobs. 5,000 banks closed permanently, taking with them the life savings of millions of families who had done nothing wrong except trust the institutions that held their money. 2 million Americans were homeless at the height of the crisis, living in shack cities that were named, with bitter irony, after Herbert Hoover. Suicides increased by 30%. Agricultural prices collapsed, wiping out entire farming communities across the Midwest. Children dropped out of school to work. People who had owned their homes for decades lost them. The psychological damage to an entire generation was so profound that many Americans never fully trusted financial institutions again, continuing to hide cash in mattresses and under floorboards well into the 1950s and 1960s. What happened to Charles Mitchell? In 1933, he was summoned before the Senate Banking and Currency Committee. Senator Carter Glass, co-author of the Federal Reserve Act, asked him directly, did he consider himself responsible for the ruin of millions of American families? Mitchell replied that he had wanted to give ordinary people a chance to get rich. Nobody had been forced to buy stocks. During the same hearings, the committee discovered that Mitchell had arranged his personal finances to avoid paying approximately $850,000 in federal income taxes during 1929, the very year his decisions helped trigger the worst economic catastrophe in American history. He resigned from the bank in disgrace. He was charged with tax evasion and tried in federal court. He was acquitted because the specific structure he had used to shelter his income was technically legal, even though the Senate committee called it a moral outrage. He spent the following years in relative obscurity, working as a financial consultant in Europe, eventually returning to the United States to run a small investment firm. He died in 1955 at 78 years old. He never acknowledged his role in what happened, not in any letter, speech, or interview that has survived. He maintained, apparently to the end, that he had tried to do something good. His bank survived everything. The National City Bank, after Mitchell's departure, stripped out its high-risk operations, returned to conservative banking, and received government support because it was considered too important to the financial system to be allowed to fail. It absorbed failing competitors at cents on the dollar. By 1935, it had a larger market share than before the crash. That bank today, after a series of mergers and renamings, is called Citibank. The country that survived the Depression tried to make sure nothing like it could happen again. Congress passed the Glass-Steagall Act, separating commercial banking from investment banking, so banks could never again gamble with the savings of their depositors. The Securities and Exchange Commission was created to oversee the market. Federal deposit insurance was established so that ordinary Americans would not lose everything if a bank failed. Strict margin requirements were imposed. These were not abstract regulatory preferences. They were the direct lessons of watching the exact mechanism Mitchell had built produce the exact catastrophe it was always going to produce. Congress was, in that moment, correct. The reforms worked. For the next 60 years, the American financial system did not produce a systemic collapse on the scale of 1929, because the specific tools that had made 1929 possible were regulated or prohibited. And then, starting in the 1980s and accelerating through the 1990s, those protections were dismantled. The Glass-Steagall wall between commercial and investment banking was repealed in 1999. Margin requirements were loosened. Leverage restrictions were softened. New financial products were created that recreated the same pyramid structures Mitchell had used, but in the mortgage market instead of the stock market. The same logic that had made National City Company's pitch so seductive in 1924 was used to sell adjustable-rate mortgages to people who could not afford fixed-rate ones. The same margin amplification that had made stocks seem like guaranteed wealth was used to create mortgage-backed securities rated as safe as government bonds. The same fundamental structure, leverage on leverage, each layer collateralized by the one below it, the whole pyramid resting on the assumption that prices only go up. In 2008, the ratchet reversed again. The same cascade: falling prices, margin calls, forced selling, more falling prices, banks that could not cover their positions, government bailouts of institutions that were too big to fail. The same playbook, 79 years later with different instruments and different names. The crisis of 2008 was not the result of ignorance about what could happen. It was the result of a deliberate decision to remove the guardrails that had been installed specifically to prevent it, because the people who profited most from the absence of those guardrails had spent decades and hundreds of millions of dollars lobbying to have them removed. Today, 50 million Americans trade stocks through smartphones, platforms designed with the visual language of video games, bright colors, confetti animations when you make a winning trade, simple interfaces that hide the complexity of what you are actually doing. Margin lending has reached $900 billion, approximately the same proportional levels as 1929. A new generation has poured money, in many cases borrowed money, into cryptocurrency, into options contracts, into meme stocks that have no business fundamentals and no intrinsic value beyond the belief that someone else will pay more for them tomorrow. The pitch is exactly the same pitch Mitchell made in 1920, democratizing finance, giving ordinary people access to the tools that the wealthy have always had, making everyone a capitalist. The shoeshine boys are giving stock tips again. They are giving them on Reddit and TikTok and YouTube instead of on street corners, but the information asymmetry is the same. The people who built the platforms that make trading feel like a game understood exactly how the system worked. They did not build those platforms to help ordinary Americans build wealth. They built them to generate transaction data, payment for order flow, and the same kind of extractive revenue that Mitchell's National City Company generated a century ago. There is something important to understand about Charles Mitchell that tends to get lost in the larger indictment. He was not a pure cynical predator. His letters and speeches suggest a man who genuinely believed he was doing something good for the country. He thought, or at least he thought, that democratizing access to the stock market was a moral project, a correction of an unjust system that had for too long out the best wealth-building tools in the hands of the already wealthy. This sincere belief made him more dangerous than a simple crook, because it allowed him to recruit allies, inspire imitators, and sustain the system for years beyond the point when a pure profiteer might have quietly cashed out and disappeared. The most dangerous salesmen in history are always the ones who believe their own pitch. Mitchell told Congress he had wanted to give ordinary Americans a chance to get rich. What he gave them, in practice, was a chance to lose everything they had, in a system structured to transfer their losses upward to the institutions that had designed the leverage, and to do so at the precise moment when those institutions had already quietly exited their own positions. The exits were never announced. The timing of the institutional selling was never disclosed. The margin calls were always the investor's problem. The bailout, when it came, was always the bank's solution. The Great Depression changed the psychological DNA of a generation of Americans. People who lived through it never forgot what it felt like to watch paper wealth evaporate, to receive a margin call on money you did not have, to watch a bank foreclose on a house your parents had spent 30 years paying off. Their frugality, their distrust of financial institutions, their insistence on keeping something physical and real in reserve was not irrational fear. It was the correct lesson drawn from a precise and documented experience of exactly how the system behaved when the pressure became too great. Their grandchildren forgot, not because they were careless or stupid, but because forgetting is what happens when the people who lived through something die and the institutions that benefited from the crisis being forgotten spent considerable resources helping the forgetting along. The financial industry never accepted that the regulations imposed after 1929 were legitimate or appropriate. From the first day Glass-Steagall was signed into law, the lobbying effort to repeal it began. It took 66 years, but it worked. By the time the repeal happened in 1999, most Americans alive had no personal memory of the Depression. The frugality and institutional suspicion of the Depression generation seemed, to their grandchildren, like an eccentric overcaution, the financial equivalent of hiding money under the mattress, obviously unnecessary in a mature and well-regulated modern economy. The lobbyists knew this. They had waited for it. The generational turnover that makes forgetting possible is also the generational turnover that makes dismantling protective institutions politically feasible. Their grandchildren forgot. The next time you see a new platform promising to democratize investing, to finally give ordinary people the tools that used to belong only to the wealthy, the next time you watch a financial product being sold with the language of empowerment and access and opportunity, remember Sunshine Charlie. Remember what he said he was doing. Remember what he actually built. Remember the $14 billion lost on a single Thursday. Remember Edward Hopkins in his garage in Detroit. Remember the bread lines wrapping around city blocks in a country that had, just 3 years earlier, believed itself to be permanently and self-evidently the richest place on earth. The shoeshine boy never sees the exit before the shoeshine boy's clients do. And by the time the ordinary investor knows which stocks to buy, the people who sold them those stocks are already somewhere else, counting a different kind of money. But there is more to this story than the crash itself, and more to understand about the system that produced it. To see the full picture, you have to look at what was happening inside the National City Bank during those boom years, behind the cheerful advertisements and the inspirational sales pitches. Mitchell's organization was not just selling stocks to retail investors, it was also underwriting the stocks it was selling, meaning National City was being paid by corporations to help them issue new shares to the public, and then selling those same shares to its own banking customers. This is what today would be called a conflict of interest, so severe it would violate multiple federal laws. The bank had a financial incentive to sell as many shares as possible at as high a price as possible, and its customers, the people trusting the bank to act in their financial interest, had no way of knowing that the bank was on the other side of the transaction. Some of what the bank sold was genuinely worthless from the day it was issued. Senate investigators in 1933 discovered that National City had sold hundreds of millions of dollars of bonds from Latin American countries that its own analysts had privately described as deeply troubled credits. Internal memos showed that company researchers had flagged the risks. Those memos were never shown to the customers who bought the bonds. The bonds defaulted. The customers lost their money. The bank had collected its underwriting fees before any of that happened. This was the structure that Mitchell had built under the banner of democratizing finance, not a system that gave ordinary Americans a fair chance to participate in wealth creation, but a system that used the language of opportunity to extract money from people who could not afford to lose it, while the people running the system protected themselves with information the customers were never given. The role that the Federal Reserve played in what happened deserves more attention than it usually receives. The Federal Reserve had the authority to stop what Mitchell was doing. It had the power to raise margin requirements and force the banks to reduce their speculative lending. It issued warnings. It asked nicely. When Mitchell publicly overrode those warnings in March of 1929, the Federal Reserve backed down rather than escalate the confrontation. The institutional deference to financial power that prevented the Federal Reserve from acting aggressively in 1929 is the same deference that prevented regulators from addressing the mortgage bubble in 2005 and 2006, when the evidence of what was coming was already visible to anyone willing to look at it honestly. The Federal Reserve has never been fully independent of the financial institutions it regulates. This is not a conspiracy. It is a structural reality. The people who sit on Federal Reserve boards, who advise its governors, who rotate in and out of its decision-making positions, are predominantly people who have spent their careers in finance. They share the assumptions, the frameworks, and, in many cases, the social networks of the institutions they oversee. When a Charles Mitchell tells them the market needs liquidity, they are inclined to take his word for it, because he is one of them, and they are inclined to trust their own. In the aftermath of the crash, the political and cultural response was as significant as the economic one. Herbert Hoover, who had been elected president in 1928 on a platform of permanent prosperity, spent the first years of the Depression insisting that the economy was fundamentally sound and would correct itself without government intervention. His Secretary of the Treasury, Andrew Mellon, who was one of the 3 or 4 wealthiest men in America, reportedly advised Hoover to liquidate labor, liquidate stocks, liquidate farmers, liquidate real estate, and purge the rottenness out of the system. The assumption underlying this advice was that the Depression was a necessary and appropriate punishment for the excesses of the 20s, and that ordinary people who had bought stocks on margin deserved to lose their savings as a lesson in fiscal responsibility. The people giving this advice did not lose their savings. Andrew Mellon's fortune survived the Depression intact. Franklin Roosevelt, elected in 1932, took a fundamentally different approach. His New Deal programs, the Civilian Conservation Corps, the Public Works Administration, the Agricultural Adjustment Act, were attempts to use government spending and employment to replace the aggregate demand that had collapsed with the stock market. But the most enduring legacies of the Roosevelt years were not the jobs programs, which were always too small and too underfunded to fully address the scale of the economic disaster. The most enduring legacies were the financial regulations, Glass-Steagall, the Securities and Exchange Commission, Federal Deposit Insurance, strict margin requirements. These were the direct institutional responses to the specific mechanisms that had produced the crash. Glass-Steagall worked by building a wall between the commercial banking business, taking deposits and making loans, and the investment banking business, underwriting securities and selling them to investors. Mitchell's National City Bank had combined both functions, using depositors' funds to support its speculative activities and selling securities to the same customers whose deposits it held. Glass-Steagall made this impossible. After 1933, a bank could be a commercial bank or an investment bank. It could not be both. For 66 years, this worked. There were financial crises in that period, the savings and loan collapse in the 1980s, the stock market crash of 1987, the long-term capital management collapse in 1998. But there was no systemic crisis on the scale of 1929, no event that threatened to collapse the entire financial system at once. The wall between commercial and investment banking held. In 1999, Congress repealed Glass-Steagall. President Clinton signed the repeal. The major banks had been lobbying for it for years, arguing that the separation was outdated, that modern financial markets required integrated institutions, that the regulation was impeding American competitiveness with foreign banks that faced no such restrictions. The arguments were presented with sophisticated economic modeling and backed by enormous campaign contributions. The financial industry spent approximately $300 million lobbying for the repeal. Within 9 years, the housing market had become a version of the same pyramid Mitchell had built. Mortgages were being made to people who could not afford them and sold to investors who believed they were buying safe assets, because the rating agencies, which were paid by the same institutions whose products they were rating, had given them AAA ratings. Those mortgages were packaged into securities, and those securities were then used as collateral for other securities, layer upon layer of leverage, each layer rated safe by agencies that had a financial incentive to rate everything safe. The leverage ratios at the major investment banks reached 30-to-1 and higher. For every dollar of their own capital, they were borrowing $30 to invest. At that ratio, a 3% decline in asset values eliminated all their capital. Everything else was borrowed. In 2007, housing prices stopped rising. The dominoes fell in the same order they had fallen in 1929. Falling asset values triggered margin calls. Margin calls forced selling. Forced selling pushed prices lower. Banks that could not cover their positions failed or required rescue. The government stepped in with hundreds of billions of dollars of bailout money to save institutions that were, now explicitly and officially, too big to fail. The crisis destroyed $8 trillion of household wealth. 8 million Americans lost their jobs. The unemployment rate nearly doubled. Nearly 4 million homeowners lost their houses to foreclosure. The names of the institutions that failed or nearly failed in 2008 became shorthand for a particular kind of catastrophe. Bear Stearns, which had survived every financial crisis since 1923, was sold to J.P. Morgan Chase for $2 a share in March of 2008, a price so low that it was nearly a gift, engineered by the Federal Reserve in a weekend transaction. Lehman Brothers, 158 years old, filed for the largest bankruptcy in American history in September of 2008, triggering a global financial panic that froze credit markets worldwide. The insurance company, AIG, had sold over $400 billion of credit default swaps, which were essentially insurance policies on mortgage-backed securities, without setting aside sufficient capital to pay the claims if the securities failed. They failed. The government provided AIG with a $182 billion bailout because AIG's collapse would have taken down every major financial institution it had insured. The executives who had built these positions received hundreds of millions of dollars in compensation in the years before the crisis. Some of them received additional compensation after the crisis paid from the bailout funds. None of them went to prison. The people who had designed and sold the securities that caused the crisis were almost universally not prosecuted. A small number of minor figures were convicted of specific fraud. The major architects of the system faced civil penalties at most, paid by their banks rather than from their personal fortunes, and in many cases returned to profitable careers in finance within a few years. The system that had been designed to prevent the bankers from suffering the consequences of their decisions worked exactly as designed. What distinguishes our current moment from previous ones is not the degree of risk in the financial system, but the degree to which ordinary people have been directly integrated into that risk. In 1929, 10 million Americans owned stocks. Today, the majority of American households have some exposure to the stock market, primarily through retirement accounts. The democratization that Mitchell claimed to be pursuing has, in a certain sense, been achieved. A much larger share of the American population now has their financial future tied to the performance of assets they do not control and do not fully understand, managed by institutions with interests that do not necessarily align with theirs. The retirement account system, which replaced defined benefit pensions over the course of the 1980s and 1990s, transferred investment risk from corporations to individuals. Instead of a company guaranteeing you a fixed monthly payment in retirement, regardless of what happened to the stock market, you now have an account whose value depends on market performance. When the market crashes, the company's liability does not change. Your account balance does. This is not a coincidence. The shift from pensions to defined contribution accounts was lobbied for by the same financial industry that benefits from managing the trillions of dollars now sitting in individual retirement accounts. It was framed as giving workers more control over their financial futures. What it actually gave them was more exposure to the same systemic risks that Charles Mitchell helped create a century ago. Mitchell died in 1955 without ever acknowledging what he had built or what it had cost. His bank survived and prospered. The regulatory framework built to prevent a recurrence was systematically dismantled by the industry that had most to gain from its absence. The tools he pioneered, the mass marketing of leveraged financial products to people who did not fully understand them, have been refined and scaled using technology he could not have imagined. There is a particular kind of financial literacy that the industry prefers its customers not to have. It is not literacy about which stocks to buy or what the price-to-earnings ratio of a given company should be. It is literacy about the structure of the system itself. Who benefits when prices rise? Who benefits when prices fall? Who holds the risk when the leverage unwinds? And who writes the rules that determine who gets bailed out and who gets liquidated? This structural literacy is not taught in school. It is not provided by the platforms that now put trading tools in every pocket. It is specifically not provided because providing it would make the platforms significantly less profitable. A customer who understands that the platform is being paid by the market makers who fill their orders, and that those market makers profit from the spread between the price at which the customer buys and the price at which they sell, is a customer who might think twice about hitting the buy button on impulse. The business model depends on the impulse. The domino sequence is still in place. The margin requirements are still too low. The leverage ratios are still too high. The rating agencies are still paid by the institutions whose products they rate. The too big to fail institutions are larger now than they were in 2008. And the shoeshine boys are giving stock tips on social media. History does not repeat itself, but the mechanics of financial destruction are remarkably stable across time because they are driven not by circumstance, but by the permanent features of human nature, the desire to believe that this time is different, that prices only go up from here, that the people selling you this particular product have your interests at heart, and that the exit will still be available when you decide you need it. It will not be. The exit is always used first by the people who know where it is.